What do you think happened, Nela?
Well, first, this is a hugely disappointing number. This is something I think just going around the horn, no one expected. But I really think that what we're seeing in the data is that the hiring we saw in March was really a recall of existing workers that were furloughed or laid off. And so it wasn't adding new jobs, it was recalling existing workers. And there was obviously a slowdown this month. We'll need to dig through the numbers, but we all expect the momentum to build over time as the economy reopens. There is something structural, I think, going on right now in terms of the jobs market and how companies are repositioning their hiring to increase margins, to reduce risk. And for workers on the other side, reducing health risks. So there's some structural things, not just cyclical at play here. And I think it's going to take a bit more time to suss all it's out, because this is not expected as a number at all.
Kate, we need to, any stimulus we're considering, we got to double, I think, at this point. I mean, why spend $2 trillion when you can spend $8 trillion? What do you think?
Yeah, Joe, that's probably a little aggressive for me. I think there are three things that really matter for the equity market right now, and I'm watching sort of the reaction in terms of the futures. But, they are rates, they are policy, and it's earnings. Earnings being the last, because we've had some very strong numbers that the market just didn't really want to reward. But I think that the rate story, which, and of course, we're seeing this play out right now, is critically important. And then the path of policy. One of the things I was looking for in this number was whether or not we were going to get an incredibly strong print that was going to accelerate the change in Fed rhetoric and also change the calculation for when we would move up to, say, 175 or 2% on the 10-year. Seems like we're backing off right now, and that's probably a good story for some of the parts of the equity market that derated as a result of higher rates.
Let me throw a question to Jason Furman. Jason, this is just the numbers made me think back to an NFIB survey that came out yesterday that showed that 42% of owners of small businesses had a hard time finding anybody who would show up for the job openings. They said they had job openings that couldn't be filled, and 91% of those who were hiring or trying to hire reported few or no qualified applicants for the positions that they were trying to fill. Why do you think that is?
This is a labor market that is 10 million jobs short of where it should be. But unlike the normal shortages that we have, I think this is just as much about a shortage of labor supply as it is about a shortage of labor demand. We have job openings at record levels. We have workers voting for their confidence in labor markets with near record levels of quits. If you look at April, it appears that there were about 1.1 unemployed workers for every job opening. So there are a lot of jobs out there. There just still is not enough labor supply. There also is not enough labor demand. So the hope over the next coming months, as the economy continues to reopen, as the vaccines succeed and work their magic, that we're going to see a big increase in labor supply, and we'll see a big increase in labor demand, and those will be well matched. That's the Goldilocks scenario. But right now, we have both supply and demand problems.
Well, I want to hear from Saira, but it is noteworthy to see the NASDAQ just take off. Like a lot of stay-at-home stocks in the NASDAQ. I don't know whether that's, but lower rates, obviously, is just like, what do you want to call it? It's like a aphrodisiac for the NASDAQ. Now up 162 points. Saira, we saw some really big moves in some of these markets, in the bond market, the dollar index, and then the NASDAQ. The S&P stabilized, but what do you make of it, Saira?
I mean, this is about growing pains for the economy. We're just wrapping up first quarter, going out with a bang, and there's a lag here with employment data, but exactly what we've been seeing is these style factors are no longer working consistently. This flip-flopping from growth working to value working. And as we get to the second quarter and we get to peak earnings growth, we think this is going to become more of an issue. It's not going to be about just owning growth or just owning value stocks. It's going to be about being more selective and finding those companies that can really benefit from stronger earnings, because investors are getting jittery, and any piece of bad news, as we saw with the Ellen's comments this week, take the market down, and that's going to continue to happen because valuations are high for this market.
Shepard Smith here. Thanks for watching CNBC on YouTube.